Yo, what's up, everybody? It is Friday, November 3rd. Yeah, Friday. So we had the October job report today. Came in at 150,000 payrolls. That's less than what we have seen the average increase over the last year. That's about 36% less, but it was still a positive number, 150. And that number actually, while on the surface it looked kind of soft and you had your typical zombie knee-jerk reaction, the monetarists, they jumped in and got all excited about maybe the Fed is going to cut interest rates or whatever, and you saw a big rally in the stock market. But actually that number also reflected the auto workers strike last month. So it was actually a pretty strong number considering that, you had that big strike and nobody really paid attention to that. But what I find interesting, and by the way, I'll skirt over the flows. The flows are strong. I don't see anything in the numbers right now that would suggest any kind of a warning sign. And again, I forecast all this a long time ago. I said we're going to rally into mid-November when we have that quarterly interest payment. I am a little bit concerned, as I always am, about the continuing resolution, which is going to expire on November 17th, and Congress got to come up with another continuing resolution, and you know how that is all the time. But right now, I'm taking the position that, like always, they're going to take it to the 11th hour and then they're going to do something. But we'll see. I mean, there's no reason at this point to speculate. I would just say November 15th, when that quarterly interest payment hits, that's probably going to be the peak in the fiscal flows until, I would say, late December. But here's something we have to think about. So that's all I want to say about the fiscal stuff now. If you want exact numbers, you got to sign up for my thing. You go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader. The one thing I want to talk about is like, now that the Fed is done hiking rates, and we see that in the implied probabilities of Fed policies based on where Fed fund futures are trading. I mean, I gave you this information. You can Google Fed Watch tool, and they give you the probabilities based on where the market is trading for every Fed meeting. So you could see for yourself. You don't have to, it's not like I have some secret insight into this. I mean, they give it to you. CME gives it to you. But here's the thing, folks. Now with the Fed, let's just call it in a pause mode. They're not going to. As a matter of fact, that Fed fund futures are actually starting to predict a rate cut in May of next year. We've had 20 months of zombie monetarist shorting of the market, selling of the market. They were all doing it. Remember this guy, Mike Wilson at Morgan Stanley, and how he was saying, the market's going to crash and this and that because rates are going. All the monetarists, not just even the zombies, but the so-called, very smart guys on Wall Street, they all had this view. Some of them still have this view. I saw a guy today on Twitter. My friend sent me a post from Twitter where a guy who proclaims to be, this big money manager, he was saying like, oh, really? You think everything is good with 16 months of an inverted yield curve? I mean, these guys are still, it's like prehistoric thinking, man. With this fucking inverted yield curve, like if you haven't seen the light at this point, that thing is so meaningless. And basically, you know what that's based on? That's based on the theory of loanable funds. That All of that stuff comes under the paradigm of like a gold standard or a fixed exchange rate that, there's only a certain amount of money out there and it could only be lent. That's all, it's all not applicable to like the current reality. And so these people are still like married to this misinformation, this total, mythology. They're just still fucking deep inside of it. And I just gotta laugh when I say, you really think this is gonna work with 16 months, this guy's been saying how, we're gonna go down because of an inverted yield curve. I mean, even the super, some of these super monetarist dudes who used to always talk about the inverted yield curve, they kind of gave up on it, and not even, some of them even said it's not a predictor anymore. Oh, really? Okay. Well, at least there's a couple of them who've said that. Anyway, what I was saying is that for the last 20 months, since they've been raising rates, we have seen very high level. I'm going to talk about market psychology and sentiment right now. For the last 20 months, since they've been raising rates, we have seen very high levels of bearish sentiment, very low levels of bullish sentiment. Even when the market was going up, the bullish sentiment never got into really extreme high levels. It was always very subdued. Like, people did not want to believe in it because of this whole, rate paradigm that we were going through, which of course they had wrong, okay? But now, if rates are actually coming down because the Fed has stopped raising them, and that's really the deciding factor. I mean, it has nothing to do with inflation. It has nothing to do with anything other than what the monopolist decides to do with the price. And the monopolist is the Fed. And now that they're done, that kind of gives a green light to the market to start, edging rates down. And if they actually do start to cut next year, wow, watch out. So what I'm saying is that this whole entire 20 months of negativity, of pessimism, of bearish sentiment, of shorting, that's all going to be unwound. And like, we went through 20 months of very high negative sentiment, bearish sentiment. We're going to go through, I don't know if it's going to be 20 months, but we're going to go through a period, a similar period, just the inverse of very high elevated bullish sentiment, because that's all they're going to look at. If the rates start coming down, forget about it. This market's going to go through the roof, even, ironically, even if the economy starts to slow down. Okay? But that would create a gigantic shorting opportunity at some point. I'm not at all suggesting you do that right now. We're only first getting into this phase, I think, where the psychology is unraveling. It's reversing, and they're starting to see, if the rates come down, I better jump in there. The FOMO rally, right? The fear of missing out. Not to mention the big embedded short position in this market, with options, with futures, with everything. I go over the commitments of traders every Friday, and I see like institutional asset managers, they got a very, very long position in S&P futures, very low. So, I mean, all of that negativity is going to come unwound. And there's going to be fireworks, man. Like, unbelievable on the upside. So I'm just telling you to be prepared. Because, and I'm going to love it, because a lot of this move up, when it happens, is not going to be about people making money. It's going to be about me and my subscribers making money, and maybe some of you guys who follow on here. But it's going to be about these guys getting crushed, taking their losses, getting out, abandoning ship, abandoning their negative ship, abandoning their bearish ship and their bearish narrative. And that's fun to watch. And that's like a big, you know, I mean, with everything going on in the world right now, I don't even want to use the word slaughter, but that's what it's going to be. But these people deserve it because they've been propagating this misinformation, and it hurt people. It hurt, there's a lot of people out there, not people like you who watch this channel, but there's people out there that they go with that. They're either out of the market and missed extraordinary opportunity. How many of you bought last week when I said, are you scared? Are you scared? That was meant to, make you think about your emotion. Was your emotion triggering certain behavior in you, like a self-sabotaging kind of behavior? I know I have subscribers that said, Mike, I was scared, but I held on. You were telling us to hold on. I held on. I had the best day of my entire year, blah, blah, blah. The best, I had great stories coming in from people. But maybe a lot of you panicked out. I sent out a thing today saying, if you seek comfort, if you seek to avoid difficulty, to avoid, disruption, then you're in the wrong game. You're basically on a path to a life of nothing. The secret is discomfort, pain, anxiety, risk-taking, going against the crowd. Those are the things that produce. I'm not saying they're easy. They're not easy, but it's like a video I made a couple of weeks ago. I said, what is courage? Courage is being scared, but doing it anyway. All right? So that's the outlook. And unless I see the numbers change, and by the way, the dollar's going down, just like I said it was going to go down, going into this period right now of expanding fiscal flows. It all hinges off of this. I mean, if you've been following me for any length of time and you don't see the correlation by now, I mean, I don't know what else to tell you other than just take the blindfolds off. This is it, both in the intermediate term and the long term. I mean, day by day, anything could happen. And I don't usually recommend, we had a big fiscal flow day, do this today. I mean, there is a correlation. Sometimes it's a day or two of a lag time. Sometimes it's exactly on that day, like when we had a first of the month payment or a Social Security. Doesn't necessarily always have to happen in a single day, but over time, when you see these trends of these flows, that drives everything. And it should be pretty obvious to you now. Anyway, folks, it's Friday. I got to go to my boxing class in a little while. And enjoy the weekend. Don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. I send out emails all day long. All right, have a great weekend. Bye.